Let's run these bulls, baby. Let's run these bulls, baby.
Hello world, this is Who Let the Bulls Out. Welcome back to part 2 in this series about recession rhetoric, interest rates, bank closures, and you. In this second video, I'm going to focus on a simple study I performed on World Bank dataset FB-CBK BRCH P5. It is publicly available. Check it out for a good time. It tracks commercial bank branch openings and closure data per 100,000 adults in the world. Overall, it suggests that banks are closing more than they're opening on a global scale. And this notion of bank closures may seem a no-brainer to some, with developments in online banking, cryptocurrency, and digital society. But to others in the audience, it may seem abnormal or an even unlikely proposition. Your experience is a combination of location, timing, and perspective, amongst other factors, and not everyone is seeing bank closings in their community yet. In the urban area where I live, I've counted at least 4 to 5 closures or downsizings among long-standing financial institutions so far this year in 2019. So the bank closure data didn't surprise me conceptually, but it awoke the bull of curiosity in me, and I dove deeply. And there are some things definitely worth discussing and exposing. I did download the dataset for myself. All figures, findings, and tables presented in this video are my own, full disclosure. I am not a financial advisor, but an entertainer and an analyst, so without further ado, what initially caught my eye was this graph I saw on the World Bank website. It suggests that starting in 2015, we had the highest number of global bank branches per 100,000 adults in history, so peak number of banks per people. Since then, 2016, 2017, we've seen a tapering off of 2.2%, so there's been a drop in banks available to people. Suggests banks are closing. And so when we run the numbers, we can see out of the initial 173 territories reporting data in the study, 89 of them or 51% experience contraction or a reduction in the number of banks per 100,000 adults. 82 of them or 47% experience expansion or a growth in the number of banks, and 2% had no change, with about 50 or so less populated territories not included in this study. This table focuses on individual countries' major output. India is the only major nation with branch expansion. You can see also Russia, Canada, Brazil, United States, and Hong Kong all experience a reduction in the number of banks per adults. China and the UK's data is largely missing, but I do think it's safe to assume that for China, Hong Kong's probably the best indicator for the Chinese economy because that's the financial and market hub. So when we look by region, one big takeaway is that regions of low income is where we see recent banking expansion. Banks are seeking the business of the unbanked, of the developing world, where people don't have bank accounts and aren't on payrolls. You can notice that there's contraction in high income regions where we see banks operating digitally, where the financial market layoffs are happening, and also where Ripple and other technologies are challenging settlement, remittance, and payment structures. When we divide the territories by level of income, you can see the higher income countries have a tapering off or reduction in the number of banks over time. Lower income and middle income nations are where there's expansion in the banking sector. So I want to propose developing world will be where the true future of finance lies. What role will phones, mobile wallets, and digital currencies play in emerging markets? And will these countries and areas of the world even need banks? Speaking of banks and financial institutions, last stock close on Friday, September 13th, we had 6 financial institutions with 52-week lows in the stock market. Bank of America, Capital One, Fairfax Financial, Unicaja Banco, South First Bank Shares, and Community Savings Bank Corp, all hitting 52-week lows. So for consideration, yes, stocks will have 52-week lows, and I'm just picking on a random 6. There's at least a few every day, so there's nothing special about these. And yes, market cycles will dictate that something has to bottom in order to reach its next peak. And yes, bank stocks leap out at me because I have a confirmation bias to find them. And yes, you can prey on these bleeding assets while they're cheap and potentially undervalued in hopes of likely future returns. But it does not change the fact that major banks are closing shop in the developed world and posting annual lows as the S&P 500 and the New York Stock Exchange retest all-time highs right now. And these financial companies are bottoming out. All I'm saying is it doesn't add up at all. But don't worry, this guy's still happy. The CEO of Charles Schwab is still smiling despite announcing a 3% workforce reduction as a general cost-cutting effort that some in the company are blaming on what? Falling interest rates. Competition from startups is a major reason that they're laying people off. Does this sound familiar? Watch my last video, part 1, about Western Union and Deutsche Bank. So what can we infer from this news about bank closures and financial sector woes? We can read between the lines, thinking critically for ourselves. Why this disruption in the financial sector? Why the banking layoffs? Why the closures? Why the reduction in bank branches per capita? One thing becomes brutally clear to me in the financial landscape right now. Software developers are replacing banks and traditional payment providers, period. David Schwartz and other technologists at Ripple have built the Interledger Protocol, ILP. It is a payments infrastructure for global settlement that's being rolled out in the background. It's revolutionary, it's scalable, and it's going to change the face of payment structures worldwide. Applications are being created that will completely revolutionize the way we interface with our own money and digital assets. One such app is called XUMM. It's the brainchild of Vitze Ven and the XRP Ledger Labs. Vitze Ven says of the project, "We're building something my mother could use and maybe would even want to use. It's a custody app for all your assets. It ties into Ripple's ILP. It's a payment authorizer, has infinite integration into existing payment platforms and networks. It'll shield your contact information. It integrates payroll from your employer or payee so that you can get paid by the month, week, job, the hour, maybe even the minute or the second. It'll shorten settlement time for global payments, and it lies at the heart of a host of applications that are being built around XUMM by the XRPL Labs. This is just one example of software replacing banks, of you custodying your own assets. This is the recipe for the future of finance. Everything we do in the digital economy is going to be recorded on a public ledger. You are going to have access to your cash and digital assets equally at the same time, with the free ability to manage, spend, loan, and donate them at will in a global digital cashless society. This is the future. A new payments infrastructure coupled with global ID will provide the new technology of the digital economy, I do believe. Please check out my global ID video from a couple months ago. Changes to the global financial infrastructure are coming. Are you going to be there to run with the bulls? Or better yet, don't wait for the pack. Be your own bull. Get out ahead of these stories. Research a little bit. I looked at global population rates for the exact same period of time. It's interesting to note that developed nations also are having lower birth rates. So the reduction in the number of banks per person is not a result of population growth. Banks are closing, bottom line. Loops me back to where we started. Banks are closing. It's not our fault. It's their fault. Let the pigs roast themselves. Share this video and educate yourself, your friends, and family. I did just want to say that in my prior video, part 1, I suggested that bond rates go down as interest rates go down. But this is not true for all bond markets. There are secondary and tertiary and resale bond markets where bond yields are not directly proportional to the movement of interest rates. So I did just want to clear that up. It was shared with me by a friend from work. Thank you for listening. Thanks for stopping by. Please do consider subscribing, liking, hitting the little bell, promoting the channel, sharing the video. I appreciate all the support thus far. My next video, also coming out today, will deal with the semiotics and the significance of Madame Christine Lagarde and her takeover of the European Central Bank. Come back for that. Peace.